Today, we will talk about the subject of Loan Credit Default Swap, LCDS. A loan credit default swap is a type of credit derivative where the credit exposure of a loan is exchanged between two parties. The structure of a loan credit default swap is similar to a regular credit default swap, CDS, but the underlying reference obligation is limited strictly to syndicated secured loans. The LCDS was introduced to the financial market in 2006 as a variation of the CDS, with the reference obligation shifting to syndicated debt instead of corporate debt. There are two types of LCDS, cancelable and non-cancelable. A cancelable LCDS can be cancelled at an agreed-upon date in the future without penalty costs, while a non-cancelable LCDS remains in force until the underlying loans are repaid in full or a credit event triggers it. LCDS and CDS can be used to hedge against or obtain credit exposure for the buyer, and they can also be used to make bets on the credit quality of an entity. The recovery rate is the biggest difference between the two. The debt underlying a LCDS is secured to assets and has priority in liquidation, leading to higher recovery values if the loan defaults. As a result, a LCDS generally trades at tighter spreads than a regular CDS. Here are two key takeaways. 1. A loan credit default swap, LCDS, allows one counterparty to exchange the credit risk on a reference loan to another in return for premium payments. 2. The difference is that in the LCDSD, the reference obligation underlying the contract can only be syndicated secured loans. Hope this would help. Thanks for watching.